All right, let's talk about some decisions that require management splitting up their costs between variable and fixed, and then looking at what of these costs are relevant to the decision and what costs are irrelevant. Some of these decisions that you will be using this type of cost classification would be things like should the company increase leverage? What that means is they need to be looking at, should we increase our fixed costs? Will that be a wise management decision? In order to do that, you need to know your contribution margin, which requires your variable costs. Remember, contribution margin is your sales minus your variable cost, and that difference is what's available to contribute to covering fixed costs, and once you've covered fixed costs, you have operating income. So what management finds with leverage is that they can be very profitable or more profitable if they increase their fixed costs by decreasing some of their variable costs, but that's only if they're going to be able to have volume that's above their break-even point. We talked about this in an earlier module, that if you fall below, if you have more fixed costs and you fall below your break-even, it has basically a multiplying negative effect on your operating income. So that would be one decision. Another would be, should we make or buy? That's basically the outsourcing question. Should we outsource or not? Oops, I can spell. The other is, should we accept a special offer? You can sometimes get a customer that will say, we want to buy a large quantity, but because it's a large quantity, we expect it to be sold to us at a reduced price. So the question would be, should we accept this? There's a lot of factors you need to take into account. So once you have to figure out your variable versus fixed, but then once you do that, you've got to go, okay, which of these are relevant to the decision? Costs are relevant if the future costs, are there any future costs that can be changed because of, as a result of the option that you choose. So it's the available options. Then what you want to do is you're going to then figure out what is, from that you'll go, okay, what are my incremental revenues? And I use the term incremental because we just want to know what are the extra revenues that will be earned by opting for one alternative versus another. And then along the same lines, you want to look at your incremental costs that are needed in order to get this incremental profit that you're hoping for. Then you have to look at, in addition to, what is this extra amounts that we could earn, you want to look at what are the opportunity costs of not selecting the other options, and that's sometimes hard to see, but it's the value of the next best alternative. And as far as that goes, I could give you an example where earlier in the modules we had Charlie's hot dog, and Charlie chose to use his money to start a business. Well, it happened to be a good investment, but what you need to look at in addition is, what could Charlie have earned had Charlie, say, invested his money in other company stock or just put his money into a bank account. So the opportunity cost would be what he would have earned in these other with these other alternatives. So you're going to be looking at the profits of the choices you did not make. Choices. Now, irrelevant costs are costs that do not change or do not differ between the alternatives. Now, as far as the hard part, I mentioned this earlier, is you've got to figure out what costs are the sunk costs. They basically are costs that have been incurred in the past and cannot be changed. Either there, whether you take on alternative A versus alternative B. So we're going to I want you to absorb that, and then we're going to do an example where we look at what costs are relevant and what are not.